All right, welcome back, everybody. This is the Audit Cast, and this episode is going to be on property, plant, and equipment, aka pp&E, aka fixed assets, aka whatever you want to call it. So let's jump right in. pp&E testing. The approach is typically done using a roll-forward testing approach. So what that means is you start with your beginning balance as of the beginning of your fiscal year. So that also happens to be your prior year audited balance. For instance, let's look at a 12/31 calendar year end client. So their last day of the year is 12/31 or December 31st of any given year. So that means the first day of their year is January 1st or 1/1. So let's say their beginning of current fiscal year date was January 1st, 2014. So let that sink in for a second. Their period under audit is January 1st, 2014 through December 31st, 2014. So backing up to that first day, that January day, the first day of the fiscal year, it also happens to be the same, essentially the same date as prior fiscal year end. So this is kind of a long-winded way to get to 12/31, let's say 13. So December 31st, 2013 is the same as 1/1/2014. So I hope everybody can see that. And it's kind of your, how do I say, your prior year end is your beginning balance or starting point from a roll forward. So let's get back out of the details a little bit. So roll forward testing is you start with your beginning balance, which was either audited by you in the prior year or audited by somebody else in the prior year. For the cases where this isn't necessarily applicable, like I don't know if a new client or a client that's never had an audit done or something, things get a little trickier there. However, you're not going to run into that as much. So I'm going to speak for the masses here and assume that the prior year numbers have been audited. So start with prior year balance as of 12/31 prior year. Then you add all the additions of PP&E, so purchases of land, buildings, equipment, machinery, office furniture, crap like that. And then you subtract out all the disposals of old stuff or stuff that's stopped being used, like the copy machine that broke that you replaced, or an old truck that broke down and they disposed of, or just trucks you sold, or machinery that you got rid of, or whatever. Those are all your disposals. And essentially, after that's all said and done, you're at your year-end balance. So let me go back over this again. You have your beginning balance that you start with. Then you add in all the new assets. You subtract out all the disposed assets. And then that's your balance as of year end. So there's going to be some other tricky pieces. We'll get into that, but I'm going through the simple part first. So to test the roll forward, you need to get a population of all those additions, the asset additions. Usually the client will have some sort of prepared roll forward schedule that looks just like what I'm describing. Starting point with beginning balance, they'll have additions, they'll have disposals or deletions or whatever they want to call them. And then that'll get them to their ending balance. So that additions balance, let's say they had $100 in assets at beginning of year. They added $200 and they disposed of $100. So their net ending balance is going to be $200, I think. So for the $200 in asset additions, you need to get a detailed listing of all the assets that make up that balance, all those additions. So make sure when you get the listing of asset additions that it agrees to the amount listed in the roll forward as additions. Got it? Okay, good. Same thing with disposals. You're going to get a listing of disposals, and you need to agree that the total in the listing to the total listed on the roll forward. Okay, so that's the roll forward. Go back and listen to that if you need to, with the actual documentation or PBCs you have from your client in front of you, because that's kind of the simple high level stuff. Now where we get a little trickier is in looking at CIP, or construction in progress. So you might see this if you're looking at your client's roll forward right now. You might be seeing that going, well, okay, man, hey, you're not telling me anything about CIP. So we're getting there right now. All right, so the way it works is a lot of companies, they put, let's see, probably by policy or just by nature of operations, they put everything into a CIP account before it goes into fixed asset additions. And there's a reason for this. A lot of assets take more time than simply just buying the asset. If that makes sense. Let me think of another way to say this. If you have an asset that you're putting in place, let's go with a simple example. Let's say you're getting some new couches. So you get some new couches for the lobby of your office. It's pretty easy to just put the couches in the lobby, and then that's it, right? Like you buy them, the 3 couches come, a love seat, a chair, and a long sofa, and you place them out there, and they're ready to go. So those would go directly into CIP immediately, and then transfer immediately out of CIP into fixed assets, because they are ready to start being depreciated immediately. Now, let's say that you buy your client or the company or whatever buys a multi-purpose fax, copier, scanner, Xerox machine thing. So they buy that from, let's call it Xerox, and they spend $3,000 on the thing, but they also have to have some IT folks come out, some third-party IT folks come out and install the actual, like, set up the network piece of it, not just the hardware, but they need to build it into their network so that people can print from every station and they can fax to themselves and do all this stuff. So they buy the $3,000 asset, which goes into CIP immediately, and then they buy the service for the network installation. Let's say that's another $1,000 that they pay. That goes into CIP. So now we have $4,000 worth of assets associated with the printer, copier, multifunction, purpose dealy-majig. You have the $4,000 associated with it, and once it's finally ready to go into use, then it can be transferred out of CIP and into property, plant, and equipment additions, pp&E additions. And the reason for this is because when the asset is in CIP, you're not depreciating it. When it gets into fixed assets, that's when you start depreciating the asset. And this makes sense, right? Because if you have an asset that's partially complete in construction in progress, i.e. it's in progress and not finished, then it shouldn't be depreciated because you're not using it. And the whole purpose of depreciating is to match your expenses, the cost of use, against the revenue generating activity. So that should make sense. I hope so, everybody, because it's pretty straightforward. But just again, remember, typically assets will go into CIP first. Then, as they're ready to be capitalized, as they're actually ready for use, then they can be pulled out of CIP, put into pp&E additions, and then ready to be used. Whether they're whatever the purpose of them is, they'll start to be used and depreciated. So you're probably asking now, how do I test that? This is always tricky on every engagement. Everybody has a different view, so I'm just going to tell you a couple different options. One, you can treat your population of additions to fixed excuse me. You can treat your population of additions to pp&E, or to fixed assets in general, as CIP additions. Let me say that another way. When you run your sampling plan, however you're going to decide what your detail testing is going to look like, you might just run it over the CIP additions for current year. And then what you would need to do to complement that is test transfers from CIP to pp&E and make sure they were, properly authorized or whatever. Because the idea there is that anything that would have been additions to CIP in current year would be your true additions that were like true purchases made throughout the year. So let's see, how else can I explain this to you guys? So if you have every purchase in CIP for the year, that population will even have transfers out of CIP into pp&E included, and that's okay, because you want to subject your population of all purchased capitalizable assets to your testing. And then the idea behind just testing the transfer out of CIP is because you've tested everything that was truly a purchase, and anything that was a purchase but maybe not purchased in current year, that should have been subject to testing in prior year. So don't take my word for that, because some people I've seen some teams that want to test CIP as its own population and additions as its own population, and it gets really tricky because CIP is usually individual invoices that you're testing. That's your unit of measure or testing unit, whereas fixed assets can get really cumbersome because a lot of fixed assets have multiple invoices and purchases and things that go into them. There's going to be services and multiple levels of contracts or building, like literal construction of assets, multiple layers, things like that. So it gets a little tricky. It's much more time effective to test CIP individual components and then test the entire transfer out of CIP into fixed assets, in my opinion. But every team is different, so good luck with that. Luckily, there's no real disposals in progress. There's no alternative to CIP. There's no kind of opposite as it relates to disposals. So really, you only have to deal with this CIP kind of intricacy with additions itself. So anyways, this has gone really long, and this is not our typical style. So I hope you guys have enjoyed. And if you have any questions, please let me know. Remember, just remember, if you're getting lost, remember to think about where you're at in your testing. You have your beginning balance. You have your additions, whether they start in CIP or not. You wind up with fixed asset additions. So you take your beginning balance, you add your additions, then you subtract out your disposals, and that gets you to your year-end balance. So you only need to test the additions and disposals, and if there's any other noise of transfers and things. But just remember, the highest level, you're testing additions and disposals, and that will get you to your ending balance. So I hope this helps. All right, guys, get back to work. Later. All right.